Hey, Archie, should politics play any role in my decisions about my investments?
No. I'm Archie Hoxton,
And I'm Rob Hoxton.
and this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck podcast, brought to you by Hoxton Planning and Management. We're your hosts, CFP professionals Archie Hoxton and Rob Hoxton, and today we're going to talk about maybe a little bit more of a controversial topic, but that is politics and the markets. We will refrain from getting into too much detail in the whole political realm, but just to talk about sort of a common mentality among investors, which is essentially to allow political beliefs or feelings about the political environment to influence their investment decision making.
Yeah, I mean, this is behavioral finance 101, really. I mean, I think that as human beings, we tend to, and even more so now because of just the news cycle and social media, but we're very much impacted based on what's happening in the political realm, right? So if we have strong political beliefs and maybe our party is not in power, then we're generally going to think that things aren't really that great. Right. And we might also infer that maybe the economy and the financial markets might not do well. And the flip side of that is if our political party is in power, we may think that things are maybe actually better than they are. So these are things that definitely we see in the practice. People ask us questions, and they're certainly influenced by their view of the sort of the political realm. So
yeah, I think when it comes to the big emotions that affect investing decision making, there's the excitement or greed or FOMO that causes people to make investment decisions that maybe don't end up being in their best interest.
Yeah, emotional.
Yeah.
Yeah.
And then there's the fear-based investment decision making, and I would say political fear is definitely a big, maybe one of the biggest. The other would be, if you actually have real fears about the economy or the markets that maybe isn't tied to politics, that can drive fear-based investment decision making. But emotional decision making is rarely effective. If it is, it's probably more luck than being right. The best kind of investment decision making is more disciplined, and we'll kind of get into that.
Do you remember last week? So this was interesting, and it was pretty subtle. But last week when we were meeting with a client, the two of us were meeting with this client, and they've been pretty stressed out over the current sort of political environment that we're in, and when the market dropped in April over concerns over tariffs, they were totally stressed, and I remember having conversations about whether or not they should get out of the market, basically move to cash or cash equivalents, and of course that's timing the market is never a good idea, and so apparently their answer to that was, okay, I just am going to stop looking at my investment account. So when they came in last week for an investment portfolio review, they came in with a great deal of trepidation, and we handed them a report, and you could tell they were nervous, and as it turns out, they said that we really haven't been looking at our accounts, so we're not really sure what to expect. And if you follow the markets, then you know that the markets dropped pretty sharply in April, but this has turned out to be a pretty strong year, particularly for stocks. And so when we said, your portfolio is up a lot on a year-to-date basis, they were really surprised.
Yeah.
Really surprised, because they fully expected their portfolio to have gotten slammed in because of their political beliefs. So it's always dangerous to think that way, and it's always dangerous to try to time the market
Right.
based upon your fear or greed emotions.
Yeah. Often the right thing to do is exactly what they did, which was just to stop looking. If you have a good plan in place and you have, or especially if you have a professional manager on the account, that's usually the best thing to do, because if you look away, you kind of forget about it. You might be pleasantly surprised and you'll be less tempted to make bad decisions. The reality, though, when you look at the historical reality of the markets in various political environments, the markets can do well under, under either party in various political environments.
They can also do badly.
They can also do badly.
Yeah.
And normally the reason for that is because the markets are actually focused on the business environment, on the economic environment. And that's when investors collectively are moving their money in and out of the market, that's the primary concern. And politics can have a shorter term impact, normally very short term, just like this year, very, very short period of volatility that kind of worked itself out. And, and historically, typically, if we have an election, the first 100 days after the election often is the worst period of that entire election cycle for the markets, because there's change happening, there's political uncertainty, and the stock market doesn't like instability and uncertainty. The more investors feel like things are stable and predictable, the smoother things tend to be in the markets.
And you see that if you look at markets where you had divided government in Washington,
Yeah.
Where there's a little bit of gridlock, then that supports the status quo, stability. The markets tend to like that. So all things being equal, if you have a split situation in Washington, that can be favorable as well.
Yeah. Now, this isn't to say that the political world can't have influence on the markets. There are actions that politicians can take that can affect things, right? If you have a change in the tax code, that can have an effect on the markets. If you have a change in fiscal policy and the types of spending the government is doing, that can have an impact on the markets. Business regulations, whether it's regulating or deregulating, that can have an impact. So it's not that there's no impact whatsoever. I think the point is that there's the fear that people tend to feel around the political environment can lead individuals to make poor investment decisions that maybe are unwarranted.
Yeah, I mean, what we know about the financial markets is in the short term, they're very unpredictable. You should expect periods of time where the market goes down and goes down a lot. And so your portfolio needs to be designed in such a way that but when that happens, if you're allocating your portfolio so that it's all in risk assets, you need to make sure that your financial plan works when that big correction or that big bear market comes, because it's going to happen. It's probably going to happen a few times in your retirement years. So you got to make sure that portfolio matches your financial plan and that you have the right balance of risk assets and non-risk income producing assets, enough money in your emergency fund, things like that, so that you're not drawing on a portfolio when the market's down. And then in total, it's got to be something that emotionally you can live with, right?
Yeah.
Because we are going to have difficult times. But if you look at the markets, over time, they become much more predictable. And the greatest wealth creator in the history of mankind, in the history of the universe, I would argue, has been the U.S. stock market.
Yeah.
And that's not likely to change.
No, I mean, it's certainly not. And yeah, I mean, this is another, we harp on this a lot. We talk about not trying to time the market, not acting on fear. Again, not not acting on sort of a complacent, hey, my party's in charge, things are going to go well.
So let's put more money in than we
Yeah,
should.
let's take more risk.
Yeah.
Have a good plan in place and be disciplined about it. Because the markets don't always reflect what the reality appears to be on the ground. Another example of this would be COVID. The markets crashed very briefly and then immediately turned around and went on to have a great year, which,
Yeah.
the economy was essentially shut down. That was super surprising.
The Dow went down about 35% in 3 weeks.
Yeah. That was a time where a lot of people were afraid. And there was so much uncertainty. We didn't know what was going on. It was kind of a scary time. But, if you had stuck with it and just said, no, I've got a good plan. I've allocated my portfolio based on my needs. I've got my short-term money, I've got my long-term money, my intermediate, then things, it would have worked itself out.
But I mean, if we're going to be really straightforward here, Archie, I think that having an investment portfolio without having an overall financial planning strategy, a retirement plan, if you don't have that plan, then how do you measure what you're doing in your portfolio against anything? You've got to have some foundation in planning so that you can say, when the market does do that and go down when it tends to do that, am I okay?
Yeah.
Right? So the beauty of a financial plan, at least the way that we do it, is that our clients can go into their portal, click a button, and after the market goes down a whole lot, and see if they're still okay.
Yeah.
And back in the old days, when I was first, doing this, then when we would have a big pullback in the market, we would feverishly have to rerun everybody's financial plan, pick up the phone and call them and say, hey, I know you're probably worried about what's going on in the markets right now, but we just updated your financial plan and reran it. Here are the changes that you need to make, a little bit of rebalancing of the portfolio, because there's opportunity there. But look, your plan is in good shape. You don't have anything to worry about.
Yeah. Well, that's another reason why financial planning is so important, is that it's not just that that you've done the right things in the past. It's that as time goes on, as life happens, as the markets change, as the political environment changes, and as you feel different types of concern, you can continue to know that you're still doing the right things and you're still in good shape and you're still okay.
Yeah. And, I should say we have some tools on the site, Last Paycheck website, that you can use. They're free. You can go on the Freedom Score quiz. You can take that. There's also an investment alignment document that gives you some tips and pointers that you can use. These are great tools. They don't cost anything. So make sure you go check those out.
Yeah.
But we are going to have a market correction at some point in the future. Make sure you have a plan.
Yeah. And we're going to have political changes and at some point, someone that you don't care for or a bunch of people you don't care for are going to end up, behind the wheel.
They may be the reason why the market goes down. But
You never
remember,
know.
it's temporary.
Yeah, exactly. And have a good plan in place and know how to measure whether or not you're still doing all right. Because the reality is the market can go down and you can still be all right and still be on course for your goals. And if you're not planning in such a way that ensures that whatever happens in the market, you're going to be okay, then probably need to incorporate that. That's a really important part of the planning process.
So aside from having a financial plan so that you have something to compare the portfolio against and know whether you're okay, what are some of the other things from a portfolio standpoint that people ought to be doing?
Well, I mean, for one, have the right allocation of assets. Typically, your core assets would be your stocks and bonds, stocks for growth, bonds for income and stability. You need to have the right allocation based on where you are in life. If you're coming up on retirement, if you're a ways off, or if you're in retirement. Rebalancing, another great one.
Making sure that you don't get overweight one asset class over another.
Yeah.
Being diversified.
Right.
Right. I mean, everybody right now is all jazzed up over artificial intelligence and the stocks that sort of are central to that theme. I get it. That's important. But don't put all your eggs in one basket.
Yeah.
And in April, U.S. stock market went down. You know what stock market went up? International markets.
Yeah.
Been a long time since they outperformed U.S., but they did in a big way.
Yeah.
So, being diversified in terms of different asset classes and types of sectors of the market makes a big difference.
Definitely. So, I mean, these are all really important. Another one, if you're approaching retirement, would be don't stop investing. Keep investing. And when the market, whether the market is really high and you're thinking, oh, the market's awfully high, maybe I should back off, or the market's really low, either way, just keep going. Remember, we're not looking at 1 year results. You have to look at, if you want to look at 1 year results, it's a mixed bag, a flip of a coin. It could be anything, but we want to focus on the long-term results, which in history have always been really, really great. Like we said, the greatest wealth builder in the history of the universe. So, keep your eye on that and keep investing. So that, I think that's probably about all the time we have today. I'm sure we could keep talking about, market timing and politics and all that stuff for a long time, but we'll stop it here. So if you like the episode, give us a thumbs up, subscribe to the channel, comment with any thoughts or questions, or if you have an idea for an episode you'd like to hear. Remember to check out the Last Paycheck website, get your freedom score, and then share it with your family and friends, and we'll look forward to seeing you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.